Welcome back, viewers at home. You're still tuned in right here on INX Prime, channel 345. Now, Phumelele Ndumo has been at the forefront of helping South Africans achieve financial independence and security. Now, she is the founder and lead financial advisor of ThuthukaSA, an authorized financial services provider. Phumelele is also the author of the South African bestseller From Debt to Riches, which has sold over 30,000 copies, empowering countless individuals to take control of their financial futures. As we approach the implementation of the new two-pot retirement system on the 1st of September 2024, there are many questions and concerns from those with pension funds, provident funds, retirement annuities, and pension preservation funds. Now, she'll help us unpack this new system, clarify key points everyone needs to understand, and provide guidance on how to navigate these changes wisely. Phumelele, good evening and welcome to INX Prime.
Good evening, Maimuna, and I would also like to thank you for having me again.
It's always a pleasure because you give us that financial understanding that we need to best make proper decisions that will actually benefit us as individuals. Now, Phumelele, this evening I want us to start by firstly understanding, if someone says two-pot retirement system, what exactly are they saying? Can you just briefly give us an explanation as to what is that and why it's being introduced?
Okay, maybe, excuse me, I've got a bit of a flu. Maybe to explain the two pots. The first pot is what is called a savings pot. And as the name is trying to describe, is that pot you can use if you need money in case of an emergency.
Okay.
How that pot will be funded is on the eve of the 1st of September, which is basically on the 31st of August, you will not have any money in the savings pot. But most of us would have maybe a retirement annuity in their private name. You may have a pension fund, which is basically an employee benefit. And some people may even have pension preservation funds and so forth. So what's going to happen effective 1st of September is 10% of the money that you have currently in your RA pension fund or a preservation fund. 10% of that, up to a maximum of 30,000, will be allocated to your savings pot. So if you have more than 300,000 as a fund value in your existing pension funds, you are going to have 30,000 transferred to your savings pot. So that is the first pot. And you can think of that 30,000 as what they call seed capital. Your retirement pot initially will, on the 1st of September, there will be no funds in there. Okay. What will happen going forward? Every monthly contribution that you make towards your pension or your retirement annuity will be broken into two. A third will be allocated to your savings pot, and 2/3 is going to be allocated to your retirement pot. So those are the two pots, the savings pot and the retirement pot. And you may then ask, what's going to happen to the funds that you already have? Let's say maybe you are a member of a pension fund and you have 500,000 there. That 500,000 will go into what others may even think of as a third pot, which is the vested pot.
Okay.
So that money will remain in the vested pot, but 10% up to a maximum of 30,000 will go into the savings pot. So those are the basically two pots, with the third pot being the vested pot. You also asked another question, why is this happening?
Yeah.
Now, most of us, we work throughout our lives, and some of us are lucky enough that, we'll get a job in our 20s, finally retire in our 60s, yet statistics inform us that only 6% of South Africans can afford to retire financially comfortable. So what's been happening over the years is that when we change jobs, we cash our pensions, and we use our pensions maybe to buy cars or renovate our homes or whatever it is that we need money for. Some people even will resign from their jobs so that they would use their pension funds to pay off their debts. Now, that basically puts pressure on you as a person, because most of us, we think retirement is far off, it's only going to happen in our 60s. And unfortunately, we wake up in our late 50s, we realize we have not saved enough. And by then, it's too late to start saving. So, one of the key objectives of the two-pot retirement system is to, in effect, save us from ourselves. Because with the retirement pot, you cannot touch that money. By legislation, you cannot touch that money until you go on retirement. Now, they've tried to balance our needs, because the reality is most of us in our lives will go through a tough time, and we will need money to manage whatever crisis that you are faced with. So to ensure that when that happens, at least you can have some access to your pension money, the savings pot was created for that reason. That is why you are allowed to access money in your savings pot, and you can access, in terms of the rules, you can access a minimum of 2,000 and up to whatever amount is in your savings pot. So I hope I've managed to explain why this two-pot retirement system had to be put in place to ensure that at the end of our working lives, hopefully we'll have enough money to go on pension and retire financially comfortable.
Now, looking at what the two-pots system is offering to individuals with pension funds or retirement annuities, I want to just understand to you for you to explain to us in terms of some of the implications that come with withdrawing the money and not withdrawing the money, because we get people who are now considering resigning. There's a whole lot of commotion around this whole two-pot situation. If you can just break it down in terms of what are some of the implications that comes with withdrawing the money or not withdrawing the money.
And I'm happy, Maimuna, that you're asking that question, because there is so much confusion, there's so much misunderstanding of what is really going to be happening. Before I even say anything, I'm going to caution those people, and I've been cautioning even our customers who've been writing to us to say, I want to resign, I want to withdraw money. And each time we speak to them, we realize that some of these decisions are made because people have received half the information, are not fully informed about what is going to be happening. So my caution is, please seek financial advice before you take any drastic action, especially before you resign, because somebody has misinformed you and said your money is now going to be locked until you go on pension. Yes, the money that is going to be locked until you go on pension is money in the retirement pot, the second pot. But whatever monies that you've accumulated from whenever you started working up to 31st August, which is next week, sometime next week, that money will go into the vested pot. So you don't have to resign to access that money, because the current rules are going to apply to the vested pot. And what that means, remember that in the current system, retirement system, when you resign from your job, you are able to cash the money in your pension fund. So you will be able to do so. It's not in your best interest, but you will be able to do so because that money you invested there under the current legislation. So the only money that you will not be able to access when you go on the retirement is money that will be sitting in the retirement pot. That 2/3 is going to remain there until you reach retirement age.
Now, Phumelele, unfortunately, we've run out of time, but I believe this is not the last time we're having this conversation, since the 1st of September is quite a couple of days away. We still have enough time to continue normalizing these conversations, which are quite necessary for our viewers at home, so they don't go about making very quite costing decisions that will find them, you know, in hot waters, so they say. But thank you so much for joining us this evening.
Thank you so much, Maimuna. I wish I had 1 last minute.
If you may.
Thank you so much. Just one thing that I also want to caution. Because I know many people are already writing to us to say, can I withdraw my money? I believe we can now access our money. One thing that I want to say is, please note that if you are going to be withdrawing your money on the 1st of September, you will not get the 30,000 that will be there, because that money is going to be added to your salary and is going to be taxed according to your marginal tax rate. And there is also going to be transaction fees. And these fees can be anywhere between 100 rands and up to a maximum of 600 rands. So, and again, if you owe SARS money and there are any penalties that are outstanding, SARS is going to deduct all of that before they give the money to you. Hence, really access this money if you have absolutely nowhere else to tap into. Be mindful of those deductions before the money will get into your bank account, especially the tax implications.
Thank you so much, Phumelele, and apologies for such a limited time. But thank you so much for joining us.
Thank you so much, Maimuna. Thank you.
Viewers at home, when all things come to money, always take your time in informing yourself on the decisions that you take, either be it acquiring money or spending money, or in this case, withdrawing from your retirement fund or pension fund. Make sure that that decision comes hand in hand with research done by yourself, through your financial advisor, and not friends and not community and not your circles, but someone with the expertise and knowledge. As Phumelele shared, that, you know, getting the money, it comes with taxation and you not accessing the full 30,000, amongst other aspects of this two-pot system. So make the right decision and save yourself, and save and protect your money. But that's where we close it for now. Let's head over to an ad break. See you when we come back.